Fed speakers are welcoming progress on disinflation, but questioning how long it will take. The US dollar continues its rise against the yen, Thailand's GDP surges, and there's scepticism around China's property rescue. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ New Zealand senior economist Miles Workman looks at why the Reserve Bank of New Zealand may stay on the sidelines as the economy goes through a period of soggy growth.
They need to see this in order to get on top of this inflation. So it is painful and it is certainly an unhappy adjustment for large swathes of the economy, but it is also a necessary one to get the economy on a sustainable footing.
But first, in 5 and 5 with ANZ, the US dollar and Treasury yields are trading slightly stronger this morning as a lack of data saw traders focus on comments from a number of Federal Reserve members saying they're confident that interest rates at least don't need to rise, but that it might take more time for inflation to fall comfortably back to target. The US dollar index was up 0.1% at 5 a.m. Sydney-Melbourne time. It's up 0.34% against a weaker yen, above 156, and extending the gains it's seen since May 16, when it was around 153. The Aussie and Kiwi dollars are trading down 0.3% at 66.73 US cents and 61.12 US cents respectively. ANZ economist Bansi Madhavani says comments from a number of Fed board members indicated they thought monetary policy was being restrictive and that the slowdown in inflation in April was encouraging. However, they indicated it was still too early to tell how long-lasting the disinflation process would be.
Interestingly, Jefferson said that Federal Reserve staff estimate that core PC rose at an annualized rate of 4.1% in the first 4 months of this year. That implies April core PC rose at 0.25 to 0.26% on a month-on-month basis. If the data are in line with current Fed estimates, it would be the lowest rise this year, confirming that disinflation is intact, but that the speed of progress in inflation has slowed. So it all comes down to data dependence and patience.
Number 2, Thailand's economy grew 1.1% in the first quarter. That was nearly double the consensus forecast. ANZ economist Crystal Tan says growth in tourism and private consumption helped offset a decline in goods exports and investment, reducing the need for a rate cut.
Overall, today's data reduced the urgency for a policy rate cut by the Bank of Thailand, especially with private consumption still holding up. We continue to expect the central bank to keep its policy rate unchanged at its upcoming meeting in June.
Number 3, China's big property rescue plan in recent days hasn't solved the demand problem in the housing market, and prices may have to fall another 35% before the market stabilises. That's according to ANZ senior China strategist Zhaopeng Xing.
The rescue plan may be sufficient to stabilize the supply side, but it remains insufficient to turn around the demand side. For the supply side, the policymakers need 5 trillion yuan for home delivery, and the rescue package can provide funds, so that we are not pessimistic about the supply side outlook. But for the demand side, we maintain our view that price will fall until the rental yield higher than 30-year Treasury yield, which is now at 2.5%.
Number 4, Zhaopeng says rental yields in China are still too high for buyers to justify jumping in, yet just on those rental yields alone.
How much further would the price need to fall to make rental yields attractive for investors? The rental yield in top-tier cities averaged at 1.6% now. So housing price may have to fall another 35% from the current level to regain the household buying interest. This will be the price bottom. The rescue plan allows local governments to buy existing unsold projects at reasonable prices, which will likely put a floor for housing prices.
Number 5, Taiwan's export orders rose 10.8% in April from a year ago. That was the biggest jump in nearly 2 years. That was driven by demand for semiconductors, artificial intelligence, and cloud computing technology. Bansi says manufacturers are also rebuilding inventories.
What is noteworthy is that major markets for Taiwan, which includes mainland China, the US, and the ASEAN, all saw strong demand in this month. We expect to see Taiwan's export demand continue to get a tailwind from the cyclical upturn in semiconductor cycle, plus the investment and expansion of AI-related infrastructure.
Bunsley Madhavani there. Now, in our bonus deep dive interview, ANZ New Zealand senior economist Miles Workman looks closely at New Zealand's soggy economic outlook, which is unlikely to get much support from the Reserve Bank, and it's expected to hold rates at 5.5% tomorrow.
Well, the outer space aliens would definitely look at the New Zealand economy as being on the soggy side. So if you think about growth over the year 2023, that came in at just 0.6% on an annual average basis. Well, that was clearly a soggy year for many households and a tough year. But the 2024 year is going to be just as tough. Our forecast for growth is just 0.5% year on year on annual average terms. And under the hood there, it's much weaker for the domestic side of the economy. So GDP is actually being propped up a little bit over the year ahead because weak domestic demand is going to reduce imports, and we are seeing an ongoing gradual recovery on the services export side via that tourism channel, which is coming back. But in terms of things like private consumption and private investment, that's actually expected to contract a little bit from the sum of the domestic economy, all these domestic components, close to 1% over 2024. So while GDP growth may eke out small positive quarterly growth numbers going forward, the situation for everyday household is going to feel a lot softer than that, because the weakness really is being driven by the domestic side of the economy as higher interest rates bite.
How does the official cash rate play into this outlook? Because normally on the face of things, when you have a slowing economy like this and a softening labour market, the Reserve Bank rides to the rescue, but maybe not this time.
Yeah, so it's very important to remember the context of this cycle, and the context being the Reserve Bank engineered the slowdown on purpose, and they did so because the stimulus provided in the wake of the pandemic, both monetary and fiscal, was ultimately too much for the economic conditions, and our labour market got too hot and inflation got too high. So the pressure the Reserve Bank has been putting on the economy via higher interest rates is entirely by design. So that's a very important distinction when we look down and we look at the outlook and see this world that is very soggy, and asking that question, why isn't the Reserve Bank coming to the rescue? Well, the answer is they need to see this in order to get on top of this inflation. So it is painful, and it is certainly an unhappy adjustment for large swathes of the economy, but it is also a necessary one to get the economy on a sustainable footing. Now, if you think about the outlook for 2024 and all the drivers of economic momentum, well, 2024 looks like it could be the first year in a long time, or in at least a few years, where monetary policy is actually getting more support from other drivers of economic momentum. And unfortunately, this is support in a downwards direction. So if you think about net migration, we're seeing that coming off its peaks now, which suggests that the impulse or the change in the change from net migration is certainly going to start weighing on growth, or perhaps another way to phrase it is not adding to demand as much as it has been. So that's turning a corner. Housing is tracking broadly sideways. It's certainly not a positive driver of growth at the moment. Business and consumer confidence is clearly dire. Our terms of trade are quite weak, reflecting a weak global economy. So New Zealand's economy is synchronizing with softer global economies as well. And of course, the government sector. The government sector is shrinking, but that is to make way for tax cuts, which will leave the private sector larger than otherwise. But dollar for dollar, we think the tax cut and government spending cut mix will be slightly contractionary overall, given households are likely to save at least a small portion of their tax relief and spend some of that on imports as well. While on the other side of the ledger, the job cuts from the government sector will certainly detract from demand.
Miles Workman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, May the 21st. Catch you tomorrow with a review of the RBA minutes. And our apologies for a slight delay in the production of the podcast yesterday because of a technical issue. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.